let's look into McDonald's and figure out the stock price. The market cap is 146.9 billion, and it's trading at 197.52. So now we know the shares outstanding. It's the market cap divided by the stock price. That gives you 744 million shares outstanding. And to calculate the intrinsic value of the stock, we have to estimate the future free cash flows of the company, then discount that number back to today's value, and that gives you the value of the entire company. Then you divide that number by 744 million, the shares outstanding, to give you the intrinsic stock price. Then we can figure out if the stock is a buy or a sell. Now let's get started. First, we need the free cash flows, and that's in the financial section in Yahoo. We'll go to cash flows. Free cash flow, that's the cash that's remaining after operating your business in a given time period. So there's no depreciation involved in free cash flow. On the income statement, they do depreciate assets, so that's why we don't estimate future net income. Net income has a lot of accounting things going on, which makes it hard to estimate. Now we need the revenue, the sales for a given year. And now that we got all that info in there, let's take a quick look. Free cash flow is positive and fairly consistent. Net income seems to be growing each year, which is a good sign. And revenue has actually declined each year, which is interesting because net income was its biggest in 2019 while revenue was the smallest. So McDonald's did a good job operating its expenses and managing its costs. So as long as the numbers are all positive, it makes it a lot easier for us to analyze and run through a discounted cash flow model. But we need the capital structure of McDonald's so we know what to discount the cash flows by. So the interest they pay on the debt is 1.1 billion. Now let's go to the balance sheet to see how much debt they have. The current debt, 59 million, not much current debt. It must be all in long-term debt. That's 34 billion. So long-term is debt due past 1 year. And they pay 3.3% interest on the debt. Interest payments are tax deductible, so let's get their effective tax rate. So the income before tax is 8 billion. And the income tax is 2 billion. So they pay 25% in taxes. So the cost of debt is 2.5%. And 19% of the capital structure is debt. That's a pretty good number. You want the lower the better, but that's good. As long as it's under 50%, it's manageable. We need the cost of equity, and first we got to get the beta to figure that out. That's a really good beta, 0.45. That's a volatility of the stock. So a beta of 1 means the stock price moves with the market. So in this case, they move half of the market, which is what you want. You don't want much volatility. Now, we have the weighted average cost of capital because we just combined the cost of equity with the cost of debt. And that gives us a 5.15% WACC, weighted average cost of capital. And that's what we're going to discount the future cash flows by. And we estimated the future free cash flows based off of the financials. And then we did a terminal value at the end, which is all future free cash flows. We discounted that number back to today's value, and we get a value of the company of $169 billion. And when you divide that by 744 million shares, we get an intrinsic stock price of $227. So it's trading at 198, so it's trading at a 13% discount. So we consider this stock a buy according to the model. And it looks like it was trading around 220 a few months ago, but then coronavirus hit and it came down. So the stock price is really based on what people are willing to pay for the stock. It's not based on what the stock is worth. Because if it was based on what the stock is worth, there would be stocks that would have a negative stock price. People look to the future when they invest. Whenever you do these types of models, you have to look at the past because you don't have future information. Nobody can predict the future. So if more people are looking to buy the stock, you will see the price go higher and higher. And if more people want to sell the stock, the price gets pushed down further and further. So it looks like the market is saying we're willing to pay $198 for McDonald's stock. So let's go a little deeper, look at their ratios. And I picked 5 common ratios But first I need some info from the balance sheet. So we'll go back to Yahoo and get the balance sheet up, and then I need a current assets. That's assets that can be changed into cash within 12 months, and that's 3.6 billion. And the current liabilities is the liabilities that are due within 12 months, and that's 3.6 billion. And the equity is, that's interesting, they have negative equity. I'm pretty surprised. So the PE is really is pretty high, not super high. I generally prefer a PE of 15. That's, as a value investor, we look for 15 because PE is a stock price over the earnings per share, and earnings per share is net income over shares outstanding. So you want a low PE because that indicates the stock price is a good value. Because as the stock price gets lower and lower, so does the PE, and it becomes more attractive. So a PE of 24 means investors are willing to pay $24 for $1 of profit. So sometimes people can't find a PE in Yahoo Finance. It says NA just because the company hasn't generated any income at that point. But fortunately, McDonald's has, so it gives us a good number to go by. And also, I forgot to mention, anytime you look at ratios, you always want to compare it to companies in that same sector. So you want to compare it to Burger King and Wendy's, these numbers, not to like Apple and Google. And also you want to compare the ratios over several quarters. So one quarter could be weak, the ratios, then the following quarter it could strengthen because some businesses are cyclical. So price over sales, I generally look for under 2.2, and they have a 7 price over sales. And this is just the stock price divided by the sales per share. And sales per share is the total sales over the shares outstanding. And the way a corporation can improve these ratios is stock buybacks. When companies buy back stocks, which happens a lot, especially the past 10, 15 years, what they're doing is they're lowering the shares outstanding, which inflates these ratios, the PE, the PS. It really inflates these numbers. So it makes it appear stronger than they actually are. Now, next is the PB ratio, and that's the price over book, and stock price over book value. And book value is the equity. It's total assets minus total liabilities. And it's interesting in this case, they have a negative book value. So according to the balance sheet, they're worth negative $8 billion. And I'm not exactly sure why. I need to look through the 10K to figure that out. But that's not a good sign. They have a good current ratio. It's about 1. Current ratio is your current assets over current liabilities. 0.98 is pretty close to 1, so it's okay. But below 1 means the company does not have enough liquid assets to cover its short-term liabilities. So it's possible it could need to take on a little more debt if sales don't improve. The lower this number, the more difficult the company is going to have to pay its debt. But the higher the number, it doesn't necessarily mean that's a great thing, because if this number is really high, that just might indicate to you that the company is not using its assets efficiently. You don't invest in companies for them to sit on cash. You invest in companies so they run a successful business and provide a return to you. So I like to see between 1.2 and 2 on a current ratio. And last is ROE, and we don't get a really good indicator on ROE because they have negative equity, but I like to see above 20% ROE. And generally the higher the better, but companies can inflate these numbers like through depreciation and through their asset base. But obviously in McDonald's case, negative, so we don't really get much of a read on that. We'd have to look at prior quarters. So I hope you liked the video, and let me know if there's other companies you want me to look at, and I'd be happy to. Thanks for watching.